Okay, in this session, we want to continue with what we were discussing last session, talking about the use of options as an alternative to risk mitigation versus using correlation. So with correlation, our goal with managing risk is to have different asset classes that are not perfectly correlated, so hopefully when one is down, another will be up and help control some of the risk of the portfolio. How does that work versus options? So the first thing I want to look at is a file I call it's an option strategy using only puts. So let's look at this. It's important to understand exactly what we have here. So I have a few columns here. I have the S&P 500 stock returns. I have some bond returns, some fairly generic bond returns of a typical bond portfolio in a mutual fund. Includes corporates and treasuries. And let's say we have this portfolio, the way it's set up is this is the portfolio that is 40% stocks and 60% bonds. And that portfolio over time, here's its returns. And then at the very end, I have a strategy where I buy 100% stocks, but I hedge it with put options. So how does that strategy do? So let's look at the average return. So the highest return is going to be stocks. If you have everything in stocks, your best return is going to be to put your money in stocks. The bond return, 5%, that's not bad. But, you better in the stocks, obviously more volatility. But your portfolio makes 7.74% return. Well, that sounds pretty good. You look at your maximum return. For stocks, your best year was 34%. Your worst year was minus 37%. That was probably 2008. With bonds, you had a pretty good upside, 18%. But your downside, the most you lost was about 3%. That's not too bad. That's good risk management. When you combine the two together, you make a return that's about 40% stocks, 6% bonds. Your max return's 26%. Your worst return is negative 12. If we look at standard deviations, for stocks, the standard deviation is 17%. For bonds, it's only 4.5%. And for your portfolio, your standard deviation is 7.79%. So let's compare that against the put strategy. With the put strategy, your return's 9.33. Now you have 100% in stocks and you made 9.33%. You say, well, wow, that's terrible because the stock market was up 11%. But remember, this is not a strategy to try to beat stocks. This is a strategy to try to beat 40% in bonds and 60% in bonds. So you can see the return is quite a bit higher. Your max return is quite good. You don't make the 37%, but you do a whole lot better than if you had stocks and bonds. Your downside, yeah, you have a little bit worse downside with the option strategy, 13.62%. But it's not much worse. If we calculate the standard deviation, though, you say, wow, the standard deviation for this strategy is really high at 14.6. So you say, well, that's not good. I'm getting a little extra return, but picking up a whole lot more risk. But what I would argue with this put strategy is the standard deviation is entirely the wrong measure of risk. And the reason I argue that is what would happen if in 2019, instead of the stock market being up 31%, what if it were down 70%? 70%. Your stock bond portfolio would have actually lost 23%. But look at your put strategy. Your max loss is still 13.6%. It didn't change. And that's why standard deviation, I think, is the wrong measure of risk for this strategy, because standard deviation assumes normal distribution. It assumes these 70% risk can never happen. And it also assumes symmetry. So that means the upside and the downside have the same shape. Well, with the put strategy, your upside has the same shape as these other strategies. It's a normal distribution, but the downside is truncated. The most you can lose is 13.62. So my argument is, you could probably argue that putting 100% in stocks but hedge with puts is a better strategy than putting 40% in bonds and 60% in stocks. My argument is you have a higher expected return, And while the downside risk might be a little greater, you know going in that the worst you can do is lose 13.62%. Now I'm ignoring what the bond market could do, so that adds a little bit of extra noise. Well, I mean, here on the stocks, we do know that the worst case is 13.6. We're not real sure the worst case on the bonds and the stocks, because markets can do whatever they do. But here, we know going in, the worst we will do is lose 13%. Why is that 13.62% there? Well, it costs us about 2 or 3% to actually buy the put options, and our put options are about 10% out of the money. So that means once the portfolio falls 10%, the most we can lose is 10% plus the cost of the puts, and that's our worst case scenarios. So it's something to think about. I'm not arguing that this is the best strategy. I think there's better strategies out there, but I'm making the point that we should think much more innovatively, think outside the box, definitely beyond just the traditional approach of stocks and bonds to manage a portfolio, and see if there are better ways to help manage risk for our clients, especially for our older clients, those near retirement. You really can't suffer huge losses. If you can go in and tell them, hey, here's a portfolio that has a higher return than what you're currently doing, and I can guarantee you for the next 12 months, the worst you will do is be down 13.6%. That is a very tempting strategy, I think, to discuss. Let me show you another strategy. This one I like a little bit better. Here, let's say we have a $350,000 portfolio, and we're going to and the stock market is at 330. This is at the end of, say, 12/31 2019. I have it as 2020, but assume this is the end of 2019. I set it up. I invest $350,000. I buy put options. I buy 11 put options because that's what's going to hedge my risk on my portfolio. If you want to know about the hedge risk, you take the value of the portfolio, $350,000, and you divide it by whatever the market's trading at right now. At this point, it was 330, and you multiply that by 100 because options trade in contracts of 100. And so that tells us that we need about 11 put options. So we're going to buy 11 put options. We're only going to sell 3 call options, because when you sell call options, when the market goes up, you start losing money. And so we don't want to lose all of our money when the market goes up. We just want to lose a little bit. But so why in the world are we selling these 3 call options? Well, we're selling the 3 call options to help reduce the risk of this portfolio. The call option is actually in the money. That's why we're getting so much more money for the call option. And the put options are out of the money. That's why they're a little cheaper. So the call options essentially offset the cost of the put options. So we're getting insurance for free. What's the cost of it is if the market shoots up, we are going to lose some money on the call options. So let's look at a portfolio. Here's the end result in 1 year. If you go back and look at this, I have this maturing in June 2021. I'm using stock prices and volatilities as of the end of 2019. This strategy does not work in a crisis like we're in right now. This is something you have to set up during normal times. So I'm assuming we set this up 12/31/2019, and then I'm going to run it for about a year from now just to see what goes on. So again, I'm not comparing this to investing in stocks. I'm comparing this to investing in stocks about 40%, in stock and bonds about 60%. And so let's look at the scenarios. If the stock market were to go up 30%, this strategy would have made about 18%. Well, if you think about that, 40% times 30% plus 60%, let's say the bond market made about 5%. Your 40%, 60% portfolio would have made about 15%. And yet this portfolio, when the market shot up 30%, this option strategy would have made 18%. You lost money because your call options are losing you money. the market went up, and so calls hurt you. The puts didn't help you at all, so your options hurt you in this case. They brought you a return from 30% down to 18%. However, if you'd had 40% in stocks and 60% in bonds, you would have only made 15%. Now let's say the stock market falls 30%. If the stock market falls 30%, you would have lost 11.5% on your 100% stock portfolio hedged with options. How would your 40-60 have done? It would have only been down 9%. So then you can say, well, wow, you would have been better off doing 40% stocks and 60% in bonds, assuming bonds are up 5%. Now realize right now corporate bonds are down quite a bit. So there's a chance your bonds would have actually been down in a scenario like this. But anyway, so you got a 30% loss. What if stocks were to fall 50%? Well, if stocks fell 50%, your option portfolio is still only down about 11%, and yet your 40% stocks, 60% bonds, assuming bonds had a positive return, which is a good chance that's not the case, you would have lost 17%. And what if the market had fallen 70%? I know that's a pretty crazy idea, but in that case, your portfolio would have been down about 10%, and your portfolio that was 40% stocks, 60% bonds would have been down about 25%. So again, it's just an idea to think about strategies, and I think what you're going to find is these strategies are going to change. They're going to be very different depending on what the price of the options are, what options markets are doing. So in a market like we're seeing today, it's too late. This is something that the investors should have been doing back in December of 2019 when markets were much more stable and option prices are much cheaper. However, this is a strategy you can set up for 12, 13, 14 months. You set it up and you monitor it, and you have to throughout time watch. If the market moves a bunch, you're going to have to make some changes. Sometime throughout the year, you might want to roll it forward for another year if you look at how markets are doing. So it's a strategy that has to be managed very, very carefully. But at the beginning of the year, beginning in 2019, you could tell your client, if you do my 100% stock portfolio hedged with options, the most you're going to lose is 11%. Whereas if you're in 40% stocks and 60% bonds, you can't tell your customer. The best you can tell them is the most they can lose is 100%. You don't know, but at least with this strategy, you know the most you can lose is about 10%. I think it's a worthwhile strategy to look at in addition to other strategies. So get creative, look at different strategies. There may be some strategies that make more sense in some markets versus in others. It really is a matter of looking what the option market will provide to you and finding a strategy for your client or for your own portfolio such that you limit the downside to a level that you can tolerate, especially for a 60-year-old, 70-year-old who's in retirement. If you can tell them your worst case scenarios, you're going to lose about 11%. Boy, they're going to say, wow, I'll take that. That sounds good to me. If the most I can lose is 11%, I'd be really, really happy with that. There are times in this market when option prices get so inexpensive that I actually overhedge such that at some point when the market falls, my portfolio actually starts making money. I've done that a few times. It doesn't happen very often. The volatility index, known as the VIX, when it falls below 10%, I will usually do that, buy extra options so that if the market falls, I can actually be making money. But anyway, it's an interesting strategy. I do encourage you to look into it. There have been some studies. You might look call right and put right strategies, which are interesting approaches. There's a lot out there on the internet. We can't possibly cover all of these topics. This is a risk management class, not a derivatives class. But just to think about risk differently and think about managing portfolios differently. Just talking about my history at USAA, this is USAA's annual report from 2008. USAA actually's net worth went up in 2008. One of only, I think, just two major financial services companies whose net worth went up. I think MetLife's went up as well. But USAA was very, very rare that its net worth actually increased. And one of the things we did at USAA, I was responsible for their stock portfolio, is we used options to hedge USAA stock portfolio. You can see Joe Robles, the CEO of USAA, actually highlighted that in his letter to the USAA owners, and actually put a chart of my portfolio in his opening letter to the membership of USAA. He showed that our portfolio was up 1%. I managed the USAA P&C stock portfolio up 1% when the stock market was down 37%. And even emphasized in his letters, USAA's P&C equity portfolio returned a positive 1% last year, a result dramatically different from most equity portfolios. So my thought in that year was we had a new CEO. He had just walked in 2008. I was arguing for us to get back into stocks, but we were worried about subprime mortgages, and maybe we didn't think the stock market was especially overpriced, but we were worried about the real estate market, especially the home market, the residential real estate. And so I argued, let's get back into stocks, but let's hedge. Let's be really careful with the hedge. And boy, am I glad we did that. Can you imagine a new CEO walks in? The previous CEO hated stocks, kept us out of stocks. Joe Robles walks in as USA's new CEO. He allows me to get us back into stocks, and then we lose 37% of our portfolio. It would have been a terrible thing that I would have done to him, causing much more stress. But because we were thinking about risk differently, we were thinking about having a new CEO and making sure that we got into stocks in an intelligent way, it really helped out that year. So the purpose of this session is think about risk very, very, very differently. So if we go back to the class notes, what I want to do here is just finish up this segment on price risk. We've done quite a bit on price risk. I want to finish up this section, but just one last real life example. The Benefits Guaranty Corporation, PBGC, they are a federally chartered corporation created by the ERISA, which is the Employment Retirement Income Security Act. They're responsible for making sure if a firm goes insolvent, goes out of business, and they have a pension plan, the PBGC steps in and ensures the employees of that pension plan that their money will be provided to them, that they will not lose their pension plan because their employer went under. Prior to 2008, the management of the PBGC said, hey, we should have more in stocks. Our return's too low. We have all this money sitting here. These pension plans pay us a fee. We have this money sitting here to bail out pension plans. We should be invested in stocks. And so they greatly increased their allocations to stocks. Well, guess what happened in 2008? You had the financial crisis. Firms are going insolvent. The PBGC was picking up pension plans that they were having to insure. They were having to pay out these pension plans, and guess what was happening to their portfolio? The PBGC's portfolio was losing 30-40% on their stock portfolio. They should have done a value at risk analysis to understand, hey, when the portfolio we're investing in does badly, that's the same time that we're going to be having to insure pension plans because companies are going insolvent. So they actually implemented a strategy such that their assets would be falling more at the exact same time their liabilities were increasing. We talked about that on the question for the first exam, talking about pension plans and managing pension plans. I think PBGC did not think about this correctly. They should have thought about the tail risk, and if they gotten into stocks, they should have at least hedged that risk to make sure if there was a major crash in the stock market, which would increase the number of pension plans they would be taking over, they should have covered their risk on their asset side, but they didn't. So again, a firm thinking only about the asset side and not thinking about the assets and liability side from a price risk standpoint, and boy, the disaster that they caused. So how do you understand all of this? How do you understand price risk? You understand price risk by taking your portfolio, both your assets and your liabilities, and go to the extremes. Think way out of line. What if oil prices were to fall from $60 to $20? What if the stock market were to suddenly in a couple of weeks, fall 30% like we're seeing in the markets these last few weeks? What happens if seemingly uncorrelated events, we'll talk about this later when we talk about Douglas Hubbard. What happens if seemingly uncorrelated events suddenly become correlated because of some extreme event like the coronavirus. We need a more integrated view of risk than finance currently does. This is also known as the contextual risk management. It's thinking about everything and including tail events, extreme events. We'll talk about Nassim Taleb later in the black swan context. So it's just a different way of thinking about risk. The investment community, as we talked before, is more focused on career risk. And essentially what they say, hey, if we lose a lot of money, that's perfectly fine as long as everybody else is losing a lot of money. That is not the right attitude for our industry to have when it comes to managing risk for our customers. We need to be thinking about the risk that's at hand. I think I showed y'all this quote earlier. When you have a gun to your head, that's not the time to be thinking about your cholesterol level, but that's what we do in finance. We're worried about career risk. We're worried about peer risk. We're worried about alpha. The smallest risk of all is what we're worried about when there's a massive risk like the coronavirus, stock markets falling 30, 40%, credit spreads gapping out. That's not the time to be worried about peer risk. A quick summary on value at risk. Sorry, this session is going a little bit longer than I intended, but value at risk, there's 3 ways to calculate it. On the exam, you'll be doing parametric risk using the equation weight squared times standard deviation squared for asset A plus weight squared times standard deviation squared for asset B plus 2 weight A, standard deviation A, weight B, standard deviation B, correlation A and B. That's that more complex value at risk problem that we'll have on the second exam, even though we're not quite sure how we're going to do the final exams yet. Historical VAR and stochastic VAR, these are essentially scenarios where you run simulations. So with stochastic VAR, you run thousands of simulations. You make sure they're well coordinated, that you understand how things correlate, including at tail events, how things become more correlated in tail events. Historical risk is very, very similar, except for here your simulations are simply select points from history. And paper 2 or project 2 for our class will be doing both parametric and historical VAR. We won't do any stochastic VAR. We already talked about how to do this when we did the problems, how to figure out the historical and stochastic VAR. So I won't go through that again. There's a video that does that. All right, so we're getting to the project, and so what we'll have to do next session is we'll have to start talking about our project 2. We'll see how much of that we can do that with everything being online. Fortunately for the project, there are plenty of YouTube videos that I've created to help you through that. I'll be understanding given that everything's long distance, and I'll definitely have office hours to help you, but we'll do that starting next session. So I'll leave it there.